good evening, everybody, and thanks a lot for joining in this evening to hear Mr. Gautam Baid of Stellar Wealth Management. So, to formally introduce Gautam, I think everybody knows Gautam. You have been following him very widely on a lot of this social media, and he has been very, I think, vocal and spreading his knowledge through his bestseller book, Joys of Compounding, and a lot of wisdom he has been always regularly sharing. But again, I'll have to do that as a very formal thing. So yeah, Gautam is the founder of Stellar Wealth Partners Private Limited, a SEBI registered research analyst firm, and a small case manager for the investors in the Indian stock market. So Gautam is also a founding creator at Chapter, a curation-based learning platform. I think this is one of the most popular platform in US where he teaches the discipline of investing. Gautam is an author of international bestseller on value investing, The Joys of Compounding. And in fact, I had that privilege of meeting Gautam in person today itself and getting a signed copy from Gautam. So really thanks for that, Gautam. And previously, he has served as a portfolio manager at Summit Global Investments, a SEC registered investment advisor based in Salt Lake City, USA. So without much ado, maybe again, Gautam has been very passionate about investing in general and India in particular. And that is what brings Gautam to India and closer to us as investors as well. So Gautam, I'll just start with one very basic question. Maybe that will help to set the context as well. And then you can definitely share everything about what you are trying to do. So we have spoken on multiple occasions, Gautam, and you have always been vocal about the humongous opportunity which India is offering, right? And how by just participating in this journey and without doing much adventures, one can create generational wealth. I really like this word when you use it quite often, that we are here to create generational wealth. And just wanted to understand, and maybe I'm sure you will add more color to it, that how real is this? And it would be great if you can enlighten us and all the followers and listeners on this, Gautam.
So it's my firm belief, Rakesh, that the stock market is not a place for generating daily income. It's more a place for creating very large wealth. And when I talk about large wealth, I'm talking about generational wealth. And that is possible by focusing on the long-term power of compounding and understanding how compounding works, because many people still think very linearly, but compounding works in an exponential fashion, and that is where it lies the magic. So just to give an example, I've often talked about how at Stellar Wealth we'll be very happy if our small case clients can earn 20% post fees compounded rate for the next 25 years. But at that rate, the initial capital would become almost 100 times at the end of year 25. But you should note that out of the 100x, almost 2/3 of that come in the last and final 5 years. After the first 10 years, you'll have 6 times your money. After 20 years, you'll have 38 times your money. So as you can see, almost 62 times out of the 100 times comes in the last 5 years. And the power of compounding is heavily backloaded. And one needs a lot of patience to reap its big rewards. And that's why you should anyone interested in Stellar Wealth Small Case should subscribe only if they have a very long-term investment horizon of at least 10 years or more. Ideally 25 years. Otherwise, I recommend them to avoid our small case. This initiative is a personal mission for me to build generational wealth for many working families in India over the next few decades. And for that, I will always prioritize longevity of healthy returns over short-term or temporary high returns in any given year. So the mindset has to change to that of the big investors. Most of the big investors we see in the market today have become very large in size by focusing on the long term and staying put in the India story and believing in the India story for the last many decades. That is what will keep you in the game. Compounding and the investing is a very long-term game. And the more time you give it, the higher the chances of long-term success.
Sure, Gautam. I think that's really interesting. And just to give you some comfort to all the listeners, we will be having a very detailed Q&A session. So just after a couple of minutes where Gautam will share his philosophy and other things about Stellar Wealth Small Case. This whole Twitter space today is basically hosted to take all the queries of our listeners. So we will be really looking forward to all those questions. So I just wanted to share that upfront so that people have that comfort and people can keep on requesting to speak, and we will keep on approving all those listeners, whoever has a question. So, Gautam, again, coming to this very specific in Stellar Wealth small case, it would be great, I think, if you could share an overview of what are the products offered by you, what are the characteristics. Of course, all that has been communicated by you. It is mentioned on your website as well. But maybe because we have such a large audience, it would be great if we get to hear all that from you in person. So, portfolio characteristics, your investment rationale, and something more what you feel would be great for people to know before subscribing to your small case, or it will help them to take that decision of subscribing to your small case.
Sure, Rakesh. So, hi everyone. Thank you for joining. Wishing all of you and your families a very happy new year. Stellar Wealth Partners has launched a new product for investors in the Indian market called Stellar Wealth Small Case, where we invest in value plus growth opportunities and long-term structural trends and partner with our clients in their wealth creation journey. Listed equities, equity ETFs or exchange traded funds, and liquid fund ETFs to serve as cash positions will be the allowable constituents of our small case portfolios. Now, what is a small case? Many people keep asking this question. Many newcomers in this particular industry or people who are new to this concept, they ask me, what is a small case? So, in very simple terms, a small case is a managed portfolio concept, a 100% digital product in which investors get to subscribe to model portfolios curated by SEBI registered professionals and entities. Now, we at Stellar Wealth Small Case offer two products, Flexi Cap and Mega Trends. As regards the portfolio characteristics, investment philosophy, and the rationale of the FlexiCap portfolio, this is a value plus growth strategy which combines long-term compounders with shorter-term tactical bets like commodities, cyclicals, and special situations like demergers, merger arbitrage, promoter and management change. FlexiCap is a benchmark agnostic diversified portfolio of 25 to 30 companies with no rigid market cap constraints. And in case of mega trends, the mega trend strategy will focus on stocks within sectors which are in a long-term mega trend, and they include CDMO, CRAMS, specialty chemicals with critical application, fintech, music streaming, e-commerce, cloud computing, electric vehicles, digital transformation. And Megatrends is also a benchmark agnostic diversified portfolio of 25 to 30 names with no rigid market cap constraints. In case of the FlexiCap portfolio, the annual fee is 15,000 plus GST. And in case of the Megatrends portfolio, the annual fee is 12,000 plus GST. In both the cases, the fees is charged in advance. Small case fees are not charged at the end of the quarter or the year. There is no profit sharing or AUM based fee mode for our small cases. The annual fee remains the same, irrespective of multiple SIPs or multiple rebalances, and there is no incremental or extra charge for the year for doing extra SIPs or extra rebalances. The annual fee would be the same for year 2, as we don't have a 2-year package. So after 12 months, you need to renew again to receive continued diligence on the model portfolio from us. You will be sent a reminder email near the end of the 12 months to renew your subscription. All subscriptions expire at the end of their term with an automated email from Small Case sent to your registered email. And the email will contain the link for renewing your annual subscription. So that's a brief about the two products. Now, please note that some stocks in our model portfolios may be less liquid and have lower trading volumes. And that is why we have designed our small case portfolios to have a long-term orientation, minimal churn, and to reduce impact cost for clients. There is another important reason why we will keep churning to a minimum in our small cases. Because the more churn and portfolio turnover that takes place in small case, the higher the impact cost and capital gains taxes, and lower the actual net realized returns for clients compared to the small case model portfolios published gross returns. And at Stellar Wealth, we will always emphasize transparency and integrity. Our small case is a completely different product compared to any mutual fund. Mutual funds do not have any comparable strategy like ours, which is value plus growth and mega trends. As regards the risk profile of our small case portfolios, we invest in low or no debt and high growth companies. And we believe this low risk orientation will help protect and preserve a lot of wealth for our clients. In bear markets, we expect our small case portfolios to fall less than the indices. And this is very important in the context of our long-term compounding journey. It should also be noted that our FlexiCap portfolio is expected to outperform our mega trends portfolio in bull markets because our FlexiCap portfolio will include cyclical companies and even commodity stocks at times. And the mega trends portfolio is expected to outperform our flexi-cap portfolio during bear markets because it consists of more long-term compounders and high-quality businesses. That is why it is best to subscribe to both our small case portfolios as a holistic long-term solution for you. And if you can invest in only one small case out of the two, then you should select flexi-cap if you have a higher risk appetite, and you should select mega trends if you have a lower risk tolerance. Note that the time horizons and overall portfolio positioning for both our small cases will be long-term. Also, please note that there will not be any discount for any new members. All the subscribers, existing and new, will pay the same price. And we do not share any research reports on our small case portfolio stocks. Our small case model portfolio stocks are not disclosed or shared by us for proprietary and IP reasons. And basically, the annual fee is more for curating the portfolio and doing continued daily due diligence on the portfolio and sharing the rebalancing updates. With regards to how engaged subscribers need to be throughout the journey with Small Case, Small Case is a great investment platform for retail investors and busy working professionals. The ease of doing investing via Small Case is simply amazing. It is a completely digital and hassle-free experience. All the buying and selling is done by you via a simple click of a button. You just have to fund your broker account by doing a money transfer from your bank account, and then you need to go to stellarwealth.smallcase.com, or you have to search for Stellar Wealth on the Small Case app. Next, you have to just subscribe by paying the annual fee after logging in using your broker login credentials. And within 3 to 4 years, the annual subscription fee will end up becoming a tiny fraction of your portfolio value as your wealth grows leaps and bounds with portfolio appreciation and fresh capital infusion through SIPs. Please note that you should subscribe to our small cases only if you have a minimum initial capital of 5 lakh rupees or more, because we want the annual fee to make economic sense for our subscribers. So if you have a lower investment amount, I recommend that you wait till you actually build up your corpus to 5 lakhs and above, and then only you should subscribe to our small case. Educating our clients on behavioral aspects is going to be a key focus area for us at Stellar Wealth. We want to make our small case clients very happy with the value they receive, and we want them to become our brand ambassadors and heartily recommend Stellar Wealth Small Case to everyone. I also would like to thank all our Stellar Wealth Small Case family members for making Stellar Wealth Small Case one of the most popular and top bought small case for the month of December 2021, in the very first month of launch. And we consider all Stellar Wealth Small Case members as one united family, and we will be in this long-term journey together. With that, I'm happy to take your questions. Thank you, Rakesh.
Yeah, just on a side note, Gautam. So after having that book in the hand, so this is something which came to my mind and which I just thought I'll share with all the small case investors as well. That we see a lot of books, right, getting converted into movies. I really felt that this book, Your Joys of Compounding, is actually getting converted into a small case where people are now having an access to an actionable idea in a small case format, which all you have mentioned in your book. So I think this is a great opportunity for all of us to participate in this journey. With this, I would open up for all the questions which everybody might have, and please feel free to ask your questions. So we have Sahil and Satvik from small case as well on our side, where if there is any specific query on small case related stuff, we are more than happy to answer. And if there is anything about the strategy, philosophy, or the research part of it, Gautam will definitely be taking up all those questions. So we'll start with that. Yeah, Tushar, you can go ahead, please.
Can you hear me?
Yeah, Tushar, we can hear you.
Yeah.
Please
Hi,
go ahead.
thank you for the opportunity. I have one question for Gautam sir. Gautam sir, how are you reading the current market scenario? If you see in the past November and December, we had like negligible cases in India, COVID cases, but yet we were seeing a lot of correction in the Indian markets, maybe because of the FII selling. But if you see the current scenario, we have COVID rising in India and globally as well, but yet we are showing resilience in markets globally, in fact. So how do you read this?
So basically, like they say, right, bull markets climb a wall of worry, and in these case, in current times, any bad news is actually good news for the markets, because the markets tend to discount more loosening or credit easing by the Fed. And as you guys must be knowing, yesterday more than 1 million cases have come in the United States, and I guess the market is now more buoyant and jubilant that the easy liquidity conditions will continue. And if the Fed, even if the Fed winds down its bond buying program by March, suppose, the market probably will be discounting a hike further down the line. Basically, maybe a delay may happen in case of the rate hike, which the market was fearing earlier. I think we focus too much on what the FIIs are doing, but if we see what has happened this year, in spite of the relentless FIIs selling constantly for last many months, the Indian domestic investor has become a big force to reckon with. I'll share a statistic with you. As of March 2019, we had 3.5 crore demat accounts in India, and as of October 2021, we have 7.3 crore demat accounts, which means that nearly 4 crore demat accounts have been opened in just a span of 2.5 years. Assuming even a 50,000 rupees investment in each of those demat accounts, that means an inflow of more than 2 lakh crores by the domestic investor alone. So I think over time, and with the LIC IPO also about to happen very soon, I'm expecting another 3-4 crore demat accounts to open, driven by the LIC IPO, because LIC will ask many of its policyholders to open demat accounts and subscribe to the IPO. So I think there's going to be a big gush of domestic money. And with such low interest rates, the level of interest in equities as an asset class will remain very high. Plus, we are entering a capex upcycle after almost a decade. Kumar Mangalam Birla recently talked about a capex Mahotsav in India over the next 10 years. And for any long-term sustained bull market with intermittent sharp corrections, what we need is a capex cycle to drive growth. And that is what we're seeing in India now. Capex upcycle plus residential real estate cycle. These two that coupled with the PLI-driven capex should also lead to very good earnings growth for the market and the broader market over the next few years. And there is good news in terms of fundamentals taking place across sectors. You look at almost any sector, look at capital goods, look at textiles, and look at real estate, look at even in banks, the kind of commentary which is coming from the banking sector. Almost most of the prominent sectors are looking up in terms of earnings growth. And as long as earnings growth comes, I think we should welcome sharp corrections, because they will allow us to buy good stocks at cheap prices.
Okay, that really helps. One last question from my side. So, I would like to know about your views on the auto sector. This along with financials have been the two sectors which have been laggards for the past 1 year or so. Mm-hmm. But now as we are hearing, like we are reading about it, that the chip shortage issue is easing. So yes. How do you see this sector performing in the next 1 year, say?
I'm very bullish on the auto ancillary part rather than the OEMs, because see, it's very clear to us that within autos, electric vehicles is the mega trend for the next 10 years. But since, for value creation, what causes the biggest friction? It is competition, right? So I would rather look at auto ancillary, which are the sole supplier to these auto OEMs for a particular part or a particular component. And I think that is where the big money will be made. Because in case of many OEMs, through their electric vehicles, they'll be cannibalizing their own existing sales of the ICE engines. But if you play it through an auto ancillary, which is providing a critical component, I think that is where the big money can be made. And there are a few select names like that in the Indian market, which are just beginning their supplies to these electric vehicle OEMs. So that is, I think, where the big money will be made. Just basically investing, I think we should simply looking for spots where the competition is minimum, because that is where profits will be maximized.
Okay, if you could allow me one more question, sir. So how are you seeing the inflation scenario, given the fact that now we'll again be having these supply chain disruptions because of the rising cases? So this could further worsen the inflation scenario, as per your view?
I believe so. Because of the latest surge in COVID, supply chain disruptions should happen again, and that should lead to further surge in inflation. That's why in these cases, it's very important to look for companies with pricing power. A very simple example is, for example, within specialty chemicals, look for only those companies with critical application and those which have got pricing power. Because even if they are not able to pass it immediately, at least they'll be able to pass it with a lag. So at least our wealth will be preserved. So the easy money basically has been made in very simple terms over the last 1.5 years. Now we have to just go back to plain old bottom up individual stock picking. It is like in the last 1.5 years, we could basically just do sectoral calls, just buy a basket from each sector and make money in any trending sector. But now I think it's time to focus more on individual bottom-up stock picking. And there are still a few opportunities, but as is typical with most bull markets, as a bull market matures, the only cheaply available stocks are from the cyclical and commodity sectors, and all the high-quality stocks have already been bid up. So even within cyclical and commodity businesses, there are some very well-managed businesses. That is where we should, I think, focus our attention. And one more very important area now for investors, I think, is special situations, especially promoter and management change and reverse mergers, because those are still the available pockets of inefficiency in the market. And as the markets become broadly expensive, then special situations are a great way to generate alpha, even in expensive broad markets.
Okay. Thank you. That really helps, sir. I know I'm asking too many questions, but if you could allow me one more question, I would.
Tushar, I would really appreciate. We have almost like 20 more requests now. More than happy to take this last question, please.
Okay, thank you so much. Sir, how are you seeing this open up trade? Because last time we saw a lot of correction in this particular segment, but this time this segment is really showing resiliency despite the fact that we'll be again facing huge spike in the cases, and yet these trades like reopening trades are showing very much strength in the markets.
They are good for it. I think this reopening and closing down, these are just trades, like you said. They are good for a trading bounce, but I don't focus much on them for long-term wealth creation. I would look at more secular growth themes. But for people who do short-term trades, they can do trades in and out. But I focus less on this particular area of the market. I would like to rather focus on those business models which are more resilient, which are less affected by COVID, if at all. That is basically where I would focus more for the small case portfolios.
Okay. Thank you so much, sir. Thank you. Appreciate it.
Hello, Gautam sir.
Hi.
Okay, you can hear me, right?
Hi, Rohan.
You can hear me, right?
I can hear you, Rohan. Yes, go ahead.
Okay. So firstly, thanks for the opportunity, sir. My question is, what's your view on small finance banks?
We do hold one small finance bank in our FlexiGap portfolio. Again, it's a very bottom-up, it's a special situation opportunity. And I think what last few years have taught us is basically that the large dominant private sector banks are where most of the wealth creation is going to happen in the future. But within small finance banks, again, you have to be very selective and look for good management teams and companies which have got less macrofinance exposure or which are cutting their macrofinance exposure. And I think again, broadly, large private sector banks with established big CASA franchises will outperform the small finance banks in the long run. We have already seen the kind of wealth destruction that has happened in many small private banks and in many small finance banks. It just makes more sense to be very selective and be very careful in that area, because until they build up their CASA franchise, they'll always be experiencing a lot of volatility. Whenever you see any issues with any small private bank, you will often see the market just dumping all these small finance banks and other smaller peers together. So one has to be very careful and just look for companies with good asset quality and very good management. In banks, management is everything.
Yes, sir. But do you think that if the story plays well, there will be a huge wealth creation in future for the small finance banks? Because the market cap is very less compared to other private banks.
Market cap is less, but what last few years have taught me is that the larger private banks have got a very structural long-term advantage over these smaller banks. You can play, basically, if you have done your research, you can buy them, but I would recommend you to control your allocation. Basically, if you want to initiate positions, initiate with a small allocation, very small allocation, and then scale up over time as you see execution. Basically, you have to take like the same approach which we take with micro cap companies, that we take a small allocation first, and then on improved execution, we average upwards. And we keep building our position over time. I think that's a better way to build your position in such companies.
Yes, okay. And if I can ask about stocks, what's your view on AU and Equitas Small Finance Bank?
No stock specific questions, please.
Okay, no issues, sir. Okay, then thanks, sir.
Thank you.
Hello. Am I audible?
Yes, audible.
Yeah. So I have my question on the small case. Basically, you mentioned that flexi cap fund is a little bit of higher risk and mega cap is a little bit lower risk. So, is there
Right.
anything which you're planning to come up with in with medium risk, wherein both of the funds may be you may have the allocation for both funds?
At present, there's no such plans. Basically, I realized, very early that there is very clearly, two kinds of investors. One which with higher risk appetite and one with lower risk appetite. That's why we came out with two small cases. But at present, there is no plan to combine both of these. We would just like to focus on these two for the moment.
Okay. And sir, one more question would be that if we have a broking account where you are not empaneled, can we still take the subscription and trade away from that other broker?
Well, in order to, you have to go through the broker integration process if you want to participate in small case. So there are 14 brokers which control more than 90% of the total trading volume in India, which are already on the small case platform. So in case you do not have any account with those 14 brokers, we recommend our clients to open an account digitally with Zerodha. The entire process takes 10 minutes. And also we recommend, we keep receiving a lot of queries from existing clients whether they can buy and sell on their own and not follow the model portfolio. That is not something that we recommend. In order to reap the full benefits of paying the annual fee, we recommend people to strictly follow the model portfolio and the rebalancing updates, because that is the whole idea of small case, that you want to just strictly follow the model portfolio and the rebalance and just align yourself with the philosophy of the small case manager. That is the whole idea. Otherwise, because otherwise there'll be leakages and there'll be a lot of impact cost incurred by you along the way. And if your portfolio does not exactly align with that of our model portfolio, then the returns will end up diverging. So you won't really get the full benefit of paying the annual fee. So the recommended course of action is, if you don't have an account with the 14 brokers, open an account with Zerodha and then strictly follow the model portfolio and follow our rebalancing updates.
Gautam, Jay here. Are you able to hear me?
Hi, Jay.
Yeah, hi. Huge fan of your book, Joys of Compounding. Really liked it. So my question is, there are a lot of IPOs, especially in the SaaS play that are coming very recently. So when you look at these companies, one is that they have an ability that they can generate a very non-linear amount of returns over next couple of years. So, do you think that these stocks are buy at any price stocks? I mean, when you're in a company and evaluating such a company, it is very difficult for you to look at from a PE which is very archaic, right? So there is no, there is no real proper way to look at from a valuation perspective in the capability of these companies to generate non-linear return over the next couple of years. So do you think that these would be qualified to be called as buy at any price stocks?
No, I don't believe in the buy at any price philosophy, but what I do believe in is value at a fair price. And when I say value at a fair price, in these companies, like you said, rightly said, the P ratio is meaningless, because for these companies, the OPEX is the CAPEX. And that's why they'll be optically showing losses, because it makes sense for such companies with very attractive unit economics and high contribution margins to spend as much as on sales and marketing and customer acquisition upfront, because the payoff will come few years down the line. So the way to value, so we have to understand how is the market valuing these companies, and we cannot just buy all of them. We have to be, again, very, very selective and only buy the companies with very sticky clientele, sticky customer base, scalability, proven management execution. And because in those companies only, the market will look at the total lifetime value of each customer, and then the market will simply multiply the number of customers with the total lifetime value of the customer to arrive at the discounted free cash, the discounted intrinsic value of such companies. So don't do buy at any price. You have to actually put in the work and actually value these companies by doing a proper DCF. And if you think that the margin of safety is not there, even after baking in aggressive growth assumptions, then there is no doubt of shortages of opportunities in the market. We can always go on to the next. We don't necessarily have to participate in every single high growth company if it's not available at a good price. It all depends on whether you're comfortable with the margin of safety or not.
Yeah. Thank you, Gautam.
Yeah, Rahul, you can go ahead, please. Rahul, you can go ahead with your question, please. I think you are on mute, Rahul.
Hello. Can you hear me now? Am I audible?
Yeah, Rahul. Yeah, please.
Yeah, hi. Hello, can you hear me? Yeah,
Hi, Rahul.
Gautam, I was keen to ask you two questions, okay? And these are interrelated.
Mhm.
One, you said that if you have a higher risk appetite, one should go with the flexi cap fund, okay? Now, keeping I'm as a long-term investor, and I mean it by long-term means 10 years and above, okay? Nobody can
Mhm.
commit a performance benchmark, but there is one expected rate of return. Nobody can guarantee, none of us can do that, okay? So,
Right.
what would be the expected rate of return? Uh, Staying put, invested for 10 years and above, okay?
Mhm.
The second one
Mhm.
was in one of those webinars that I've been ever since you have launched on Stellar Wealth on small case. I have attended two of the webinars. In one of them, and on the tweet also, you said you'd be launching a small case for international market also. Okay.
For the US tech market, yeah. Yes, correct.
So that would also be a horizon of 10 years and above. And what kind of a risk appetite an individual should have? A medium, high, or
Same. That will be again very high. Again, with technology stocks in the US by definition are very, very volatile, as you must have observed in the last 6 months. Many high growth tech stocks in the US are down 40 to 70%. That is the kind of volatility which is present in the US tech stocks. So that particular product again will be very, very high risk, but over the long term, again that should also deliver good returns in line with what FlexiCap is expected. As far as expected returns is concerned, as per SEBI guidelines, we are not allowed to give CAGR guidance to our clients. But personally, I'll be very happy if our clients can earn 20% CAGR post fees over the very long term, over the next 25 years, because that is the whole mission behind the small case initiative, to create generational wealth, and that is only possible over the very, very long term. And it's very important to understand that this is a position of very high fiduciary responsibility. It is, small case is primarily subscribed by many retail investors and small investors and working class families. So for me, longevity of returns and durability of returns will always matter more than chasing high returns in any one given year. I would rather focus more on consistency and long term and longevity than focusing on chasing in the latest hot fad in the market.
Okay, so just the generational wealth, you use this word very frequently. When I said now generational wealth, which means about 20-25 years, we would be in the strategy that you're going to pursue in small case, you're going to book profits also, where you see that in this certain script the expected return has been arrived.
Yes.
So let's book and move ahead.
Yes.
Thanks a lot. Thanks. And when is international?
The idea. I always tell people that the idea is not to remain invested in one single stock for the long term. The idea is to remain invested in the market for the long term in a portfolio of good stocks. That is the way to approach investing. Basically, because by focusing on individual winners and losers, we just lose sight of the big picture. But the really great investors, they focus on the portfolio level returns, not the individual stock, what is happening with individual stocks. That is all that we should be concerned with, is how much is our small case portfolio delivering to us over the long term at a portfolio level. That is all that really matters. Both the portfolios are adequately diversified. And it's this is one more common question I keep getting, that why so many stocks right now. It is because in a bull market, as the earnings growth expands across sectors, we have more opportunities. So many investors' portfolios tend to become naturally diversified. In a bear market, why does the bear market happen? Because earnings growth dries up. So in the bear market, the number of stocks would automatically come down. The number of stocks is simply a function of the available opportunities in the market.
Okay.
That's
so
it.
By when is your international fund going to be launched on small case?
As soon as the small case completes all the legal and regulatory formalities, and then only, I think it will probably happen in the next 6 to 9 months, but there is no specific date right now.
And what's the duplication of scripts between your small cap, the flexi cap and the mega trends?
At present, it is 33%, but this percentage may go down over time, or it may increase during a bear market. Like I said, even in a bear market, if the number of opportunities is very less, then for selective short-term periods in a future bear market, the number of stocks may be highly common between the two small cases. Otherwise, it will range between 25 to 30%,
Thanks.
around
You
about.
answered most of my questions. Thanks a lot.
Thanks,
Thanks.
Rahul. Yeah, Mr. Vipesh, you can go ahead.
Hello, I'm
Yeah,
audible.
Mr. Vipesh.
Okay. I'm asking questions related to mega trend to Gautam because because there is a small case related to mega trend. So mega trend is basically on how to identify the mega trend in the small case scenarios. Means like earlier it was a chemical sector which is a mega trend, and now somewhere it is electric EV theme and renewable energy and ethanol space. So how we riding the mega trend? Is there any specific to FinOps like financial stocks are there in the mega trend also?
Just a second. 1 second. So financials basically, I would say, are more of cyclical stocks, and financials are more cyclical by nature. So we do have good exposure to financials, especially
Yeah,
good
can you
quality
hear me?
lenders in our flexi cap.
Yeah.
Hello, is my voice audible?
Yeah.
Yeah, so financials are more of a cyclical sector, so that would find place in the flexi cap portfolio. In mega trends, we focus more on very big long-term structural growth stories with less cyclicality in their business models, where entry barriers or exit barriers are very, very high. So we have less representation to financials in our mega trends, hardly any financials in our mega trends portfolio. We have it primarily in our flexi cap portfolio.
Yeah. And one more question related to mega trend small case only. So there is a minimum investment amount is 1.8 lakh. Sorry, 1,80,000. So is it a one-time investment amount in this particular small case? So how you suggest us to to remain invested in terms of is it a quarterly invested amount, or we need to follow again for each quarterly or monthly, on what basis, like to get the maximum return from the small case?
Basically, the minimum amount to subscribe to both the small cases is specified on stellarwealth.smallcase.com, and the minimum amount represents the amount which you require to subscribe to the model portfolio in my recommended weightages. So that is what the 1,80,000 refers to. The reason why I recommend a minimum investment amount of 5 lakh rupees is so that the annual fee makes more economic sense. If you look at most mutual funds, for many mutual funds, the expense ratio comes to 1.5 to 2%. So the idea here is to start with a minimum invested capital of 5 lakh rupees and then scale it up over time with regular SIPs, so that the annual fee becomes a tiny fraction of your investment amount. And if you feel that you cannot invest a minimum of 5 lakh rupees within 1 to 2 years, then I would myself recommend you to just avoid the small case, because I really want all our subscribers to get the biggest bang for their buck and earn the highest post fees returns. So I'm not in the game of chasing a large subscriber number. It's more to deliver very high or rather very healthy long-term returns.
Yeah.
Thank you, Gautam.
Thanks, Vipesh. Yeah, Tushar, you can go ahead, please.
Hi, Gautam.
Hi.
Nice to.
Yeah, Tushar, you can go ahead, please.
I've been a subscriber to your.
Your voice is coming very low, Tushar. Can you just increase the volume?
Yeah. So I've been a subscriber to your FlexiCap model portfolio since inception. I was just curious about one of the things, like, will you be capturing IPO opportunities as well? Because during this course, there could be certain opportunities which comes up during the course of an IPO, and I was just curious, how would you communicate to the investors to to rebalance in an IPO scenario? Because the thing is that if you are to miss an opportunity in IPO, the prices could fluctuate maybe by the next rebalancing date. So just wanted to hear your thoughts on some of the IPO opportunities which may come along the way.
Sure.
And which would fit your model portfolio, in due course of time. So.
Sure. Basically, like you already said, so the rebalance is basically sent at the end of the day. So in case we ever want to participate in an IPO in future, it will not be on the listing day. By the very design of the way the small case works, we'll be able to participate in it only on the second day. Basically, the second day of listing, not on the first day of listing. It will only happen on the second day. And frankly, for me, an IPO or FPO or any new offering which comes, I just treated every single stock is meant to be treated the same. Just we have to evaluate it in terms of intrinsic value and the long-term prospects and the valuation, and then take a call. So whether it be an IPO or an existing secondary market stock really doesn't make much difference. In case of IPOs, the only small technical thing is that we'll be able to buy it on the next day because the rebalance is sent after market hours, and the users can buy it on the next day.
Follow. Thanks. That's useful. Thank you.
Sure.
Thanks, Tushar. Yes, Sanjay, please go ahead.
Hello.
Yes, Sanjay, you can go ahead, please.
Good evening, sir.
Okay, Nitin.
Yes, sir. Good evening, sir. Nitin this side.
Yeah.
So I just wanted to know regarding this annual fee, sir. It will be same for say about like 5 years, or you have kept the annual fee same for first 2 years?
It's for the first year.
Yes,
Basically, it's only for the first year. In the future, the fees may increase if the inflation picks up further. But as of now, for the first year, for the first 12 months of operation, it's meant to be at this price only.
Yes, sir. Do you have any plan of like if a person wants to directly like enroll for say about 10 years, a 10 package, something like that?
No. There's no annual package for more than 1 year at present. Hello.
Yes, sir.
Hello?
Sir, I'm asking, do you have any, like, if a person wants to enroll for, say, about 10 years, because as such you have mentioned, like, one should get into this only if he has a horizon of, say, about 10 years. So if one wants to have a picture of, like, what he's going to pay for next 10 years, so do you have something like for a 10-year plan wherein he can get some discount on this fees, or it is on a yearly basis only one can get it renewed?
Only on a yearly basis. It's only on a yearly basis as of now.
Sir. Yes, sir. Yes, sir. Okay. Thank you, sir.
Okay.
Yeah, Mr. Chari, you can go ahead. I think you have been waiting for long. Sorry for that. Yeah, Mr. Chari.
Yeah, can you hear me?
Yeah, Mr. Chari, we can hear you.
Gautam, hi. I must congratulate you on the wonderful work you've been doing. I have read your book and it's really amazing. So I have a few questions. First off, with respect to your portfolio construct, you have already mentioned that typically you prefer a portfolio of 25 to 30 stocks, and the reason you mentioned is that beyond 30, there is really no benefit that accrues to the investor. I am myself, more of an investor with concentrated portfolio with maybe 8 to 12 stocks. I have never heard you say anything about a portfolio construct less than 30 or less than 25. So first off, I would like your views on that. Secondly, with respect to... Yeah, please.
So it's very simple. Like I mentioned in my recent webinars as well, that between 20 and 30 names, that is broadly speaking, that is the optimum number of stocks to maximize the risk return trade-off, because beyond 25 to 30 names, you don't get any benefits of diversification at all. And it's very important to understand that managing one's personal money in a personal demat account and managing public money is two separate ball games altogether. The way I've designed these small case portfolios is very conservative by nature, because I'm very focused on the very, very long term, on longevity and durability. And the idea here is to let the winners run for as long, because what happens, I want the portfolio to naturally concentrate itself. That will automatically happen when I let my winners run. Over the next 10, 15 years, there may be, few 10 baggers, which basically will go up in a big way in terms of weight, while the losers will automatically fall by the wayside, right? So the portfolios will naturally become concentrated over time, with the largest winners becoming the biggest weights and the losers basically having negligible weight in the portfolio. That will happen automatically. But to start with, I've just tried to just diversify prudently and pick the best possible opportunities, because in the bull market like we're having right now, the number of opportunities are very, very good. And I'm always thinking in terms of opportunity costs. It's not as if one stock will have a return potential of 10% and the other stock in the portfolio has got a return potential of 30%. So I'll have both of them. Most or almost all of the stocks are meant to have similar risk return profiles, and that is the whole idea behind creating this diversified portfolio. Over time, it will automatically become concentrated as we let the winners run. But to start with, we need a very solid foundation. That's why I created both these portfolios like this in the beginning.
Hello.
Hello.
Yeah, can I go ahead with my question, Sanjay?
Sure.
Yes, Mr. Sanjay, please go ahead. Can you hear me, Gautam?
I can hear you clearly. Can you hear me?
Yeah. We can hear you. So, anybody else? Abhay, please, can you go ahead, please? Abhay? I don't know. Some issue with the Twitter space today. Vivek Nayak, please.
Hello.
Yeah.
Okay. Can I go ahead?
Yeah. Please go ahead, Arvind.
Sure, sir. So very good evening, Gautam sir. I've been following you for quite some time and absolutely love your analysis. I had a couple of very specific questions to the small case. The one is the shuffling procedure, right? What criteria would you be using to reshuffle the portfolio, make changes to the portfolio?
It's very simple. Whenever I feel a particular stock has exhausted its maximum of its return potential, then I will reshuffle the portfolio. I'll give you a live example right now. So, in the FlexiCap portfolio, there is a company which is almost about to exhaust its full capacity. That basically expanded its capacity in a big way, but very soon it may fully exhaust its expanded capacity. So now that the incremental delta in earnings will be very less, so that will be replaced with a new idea. So basically, whenever we find a better opportunity, much superior opportunity, we rebalance.
Okay, sir. And the other thing was you said 20% CAGR, right, over the long term?
Over the very long term, yes. Because yes, over the very long term. Yes.
So I just wanted to know what was the logic behind coming to that number, basically 20%. How did you come up to that?
Very simple. So basically, while selecting the stocks for the portfolios, generally we look at companies which can double their earnings within 3 to 4 years. In case of companies which can double in 3 years, it comes to 26% CAGR. In case of companies which can double in 4 years, it comes to around 22%. So I just thought of being a bit more conservative. I like to under promise and over deliver. So I thought, why not just be a bit more conservative in the return expectation? But at any point of time, the idea is to buy stocks which can double their earnings over the next 3 to 4 years. So that is basically the ballpark number, 22 to 26%. And after you subtract the annual fees as a percentage of your invested capital, the idea was to arrive at a broad number of 20%. So that was the broad thinking: earnings growth less the